Good morning and welcome. Patriot Radio News Hour. Joe and Jason on this Thursday. I hope it finds you well. Here's the good news about Thursday. Tomorrow is Friday. 800-951-0592. Get your wealth insurance. Well, you still can. Yeah, before all the central bankers buy it all. Another huge buying spree by the world central banks. And, you know, it's going to be close. We may break last year's record as, again, heavy buying. China, Poland, India, Brazil. I mean, it just seems like a never. Turkey was back buying once again as well. Just to name a few, allamericangold.com. That is the website. And Jason, you know, we've had a lot of Fed speakers out saying a whole lot of nothing. You know, of course, we started out with the ridiculous Austin Goolsbee. I mean, this guy may be worse than Janet Yellen, but even Jay Powell really can't save a whole lot here as they looked at jobless claims today. Not good enough. Another 217,000 people filing for first-time jobless claims. Continuing claims has been growing, and it grew again, just under 1.85 million. You don't really get too worried about that until that number grows to at least 2 million. But when we look at jobless claims, Jason, that's not enough, right? They see 217, they're like, oh, man, that's not enough, right? We need more people to get fired than that if this is going to, you know, I guess, define the yellow brick road that Austin Goolsbee was talking about.
Yeah, we'll see if the fantasy comes to reality, which I know it won't, but we'll be here, Joe, selling gold and silver, because that's, I'll just, you know, how many times can you say you need to have a safe place to hold your savings, and your investments are at risk. You know, whatever you're invested in, you better be sure what the path is, the future of those investments are, or else you're going to be in bad shape. Otherwise, if it's saved money, the banks are just not the place to be, Joe. It's just not the place to be.
Yeah, and again, I think the banking pressures are not going to go away. You know, they had a little bit of a reprieve on a lot of hope. The 10-year note rallying today, 4, 5, 6, 4, 5, 7. Gold's up 10, silver's up 25, crude oil's up. You know, it's kind of odd, right? That you're getting like commodities rallying as interest rates rally. It's kind of supposed to work the other way, but so much data. You know, think about what we had just this week. Saying, okay, listen, I get it, right? You got all giddy because Jay Powell and Janet Yellen did one of their magic shows on the debt. And said, oh, see, yeah, well, you know, these next 2 quarters, and let's not worry about what comes after that. Then you had the data come out from the advisory committee. Yeah, go figure, right? The banks sit on the committee with the Treasury to decide, you know, how this is going to work. And I get it, right? They're the ones that got to sell it, right? They're the ones that are going to run the auctions, be stuck with all of this stuff. They painted a much different picture than the one that Janet Yellen tried to present last week, which is, hey, things aren't that bad, right? I mean, yeah, they're bad, but we're going to be okay. The advisory committee was like, well, you know, we're kind of just looking at math, and not even really hard math, right? If you just lop off all the zeros, 1 + 1 = 2. So 1 trillion plus 1 trillion equals 2 trillion, right? 2 trillion plus 2 trillion equals 4 trillion. It really isn't complicated. Then we heard from Bank of America. Bank of America said, hey, listen, Let me tell you what's going to happen over the next 10 years, okay? And here's the thing. I want to point this out. Bank of America was using the projections from the Congressional Budget Office, which we already know are absolutely not worth the paper it's printed on. Matter of fact, if we wanted to save some trees, I got a great idea. Let's just get rid of some of these government agencies that literally are no good at tracking anything. Right? We can get rid of the Fed. Think about all the paper we can save there. Get rid of the Congressional Budget Office, right? You know what I mean? Jason, so many things. But here's what they said. $54 trillion. But that's not the only number. And the Federal Reserve is going to have to greatly expand their balance sheet. Now think about this. Their balance sheet go back to 2006, 2007. Was about $700 billion. Still pretty, good chunk of money there. $700 billion. Then it grew, right, to just under $4.5 trillion. And then Janet Yellen, who, think about this. Janet Yellen was the one in charge when they decided to do quantitative tightening and raise interest rates the first time. If you don't remember how that worked out, quantitative tightening came to a screeching halt at about $3.8 trillion. And the next thing you know, Jay Powell had the thing up to $9 trillion. Picked it up from there. We'll 800-951-0592. Joe and Jason, Patriot Radio News Hour on this Thursday. Breaking news. Not huge news, but the White House is saying Israel is going to implement a 4-hour pause in fighting every day. So there you have it. So they can't get a ceasefire, but they'll take a 4-hour timeout. So it's kind of like COVID, right? Hey, as long as you're eating or drinking, then COVID's it's okay, right? If you're at a restaurant and you sat down at the table, COVID. Oh well, you're at a restaurant sitting down, so it must be okay. Same thing here with the war. We're just going to take a 4-hour timeout. I'm sure Hamas will take that timeout as well, right, Jason? Everyone, call timeout. You can huddle up, and everyone can eat some food and do what they need to do.
Sounds like a little sleep break for their troops, so that they, because 24 hours a day that could get tough, so maybe it helps with their shifts.
Yeah. Well, we know it's all about PR, right? Israel had to do something to make some people happy. Listen, this is always the problem. The markets got the same problem. Jay Powell isn't doing what's right for you and I. Janet Yellen definitely isn't doing what's right for you, and Austin Goolsbee. They're not doing what's right for you and I. They're doing what's right for what? The market. Perception. Right? How are we done raising interest rates when, the inflation gauge you love that doesn't even track inflation is at 4%? Right? When you say, well, it's only supposed to be 2, how are we done? Well, because that's what's right for the market. It's not what's right for you and I. Right? I mean, wouldn't it be nice? Hey, you know what? I need to make a little more interest because, inflation keeps killing us. But who needs that? And of course, let's face it, what is the bank going to pay you anyway? Right? At the end of the day, what are they really going to pay you? Check out our friends over at Y-Refi. First of all, they're not correlated to the stock market. They don't care what's right or wrong for the stock market. You know what they care about? They care about what's right for the borrowers that they've been helping. the student loan borrowers that the bank threw in the garbage. Right? The private student loan guy who probably 90% of these loans, it's so sad. Most of these people defaulted within the first 6 months of graduation. And if you go out to a year, right, you get, like I said, almost 90% of them. Why? Because, well, gosh, yeah, you let me borrow $40,000, $50,000, $100,000, and you know what? I didn't get a job right away. I didn't get the job I wanted right away. But 30 days after I graduated, I had to make a payment. And then guess what? 30 days later, I make another one and another one. And the second I was late, you jacked up the rate. You sent me to collections. And I can't, they can't get rid of it. It really is a great program. It really shows we don't need government. We don't need student loan forgiveness. We just need companies like Y-Refi that know what the hell they're doing. Obviously, not all of those people deserve to be helped. They know that. That's what makes them so good. They find the ones that do. And you get rewarded for being the one to help them do it. Up to 10.25% returns, fixed, not correlated to Wall Street. Doesn't matter what the bankers or the Treasury are doing, whether it's good for us or not. InvestYRefi.com. That's the word invest, the letter Y, REFY.com, or just call them 888-YREFI-24. Now, we are talking about the debt. Seemingly, a week ago, somehow, apparently the debt problem went away. And it was interesting because it went away with the Treasury saying, man, we need to borrow another $776 billion. And by the way, that will be the best quarter in 3 quarters. And again, I went to public school, so I'll use my calculator. If you did that every quarter, that'd be a debt of $3.1 trillion. Shh. Joe, don't say that. Come on, the CBO says the debt's only going to go up $20 trillion in the next 10 years. That's it. That's it. Just $20 trillion in 10 years. Right? We went, 205 years before we did $1 trillion? Now the CBO says $20 trillion in 10? Oh, but wait. Here's the problem. Bank of America said, well, okay, let's go with that number. So that's $54 trillion. But, see, Bank of America is probably a little better at math than the CBO. Now, I'm bagging on the CBO. The CBO, here's some of the dumbest rules ever. So they created this to act like they were going to get tough on spending. We got the Congressional Budget Office, and they're going to track stuff, and they're going to tell Congress what's really going on. But then they said, oh, by the way, you can only use the numbers that were given to you. Whether they're right or wrong, those are the only numbers you get to use. So if the Treasury says, hey, we're only going to have to issue this much debt, well, that's all. Even if the math sucks, you still got to use that number, right? So they essentially made it worthless. But they don't tell you that on TV. No, they come out and tell you all this great stuff. So what did Bank of America say? Well, they said, okay. Well, in that case, the Federal Reserve, their balance sheet's going to have to blow up. And I just walked you through, it wasn't even $1 trillion before the financial crisis. Then it went up to $4.3 trillion. People forget. Remember, Janet Yellen started quantitative tightening Right, we're going to shrink that balance sheet. Remember, she told everybody. I mean, and Jason, you know what? She had pretty charts in everything. Yep. Yeah, she even did a press conference. Oh, yeah, came right out on TV. She was right there on CNBC. Fox in the morning. Telling everybody, oh, yeah, we're going to lower that to, $2.5, $2.6 trillion. And that's okay because, $700 billion, the economy wasn't that big. We need a bigger balance sheet just because the economy's bigger. How far did they get? Well, they got to about $3.8 trillion. When Bank of America, by the way, as this was happening, as they had started quantitative tightening, it was in May. And I want to say 2019, 2018, something like that. They wrote a letter. And now I think Jay Powell inherited, because Janet Yellen, her term was up, and Jay Powell's taken over. So she started it, and I think he inherited it. But Bank of America wrote a letter to the Federal Reserve and said, hey, dummies, we're going to have a problem at the end of the year. And the problem's going to be there's going to be way more debt to be sold than we can handle. And of course, remember, people forget, we had all this emergency lending going on. Remember, the banks, Jay Powell created all this temporary emergency lending windows, gold shot up. And of course, quantitative tightening came to a crashing halt. Now, the one thing they didn't have then, they didn't have the reverse repo, Jason. That's why it came to a halt. See, we already know how this game plays out. Now, Bank of America said yesterday the reverse repo is going to be dead in January. And then after that, they expect the Fed's balance sheet to blow up again. So think about this. Yeah. We went from 4.5 to 3.8 up to 9. I think we're at 7.9. Let's call it, 7.8 trillion. We could be looking at a Fed balance sheet in the next 10 years that'll be somewhere in the realm of $20 trillion, Jason. I mean, it really is really hard to get your arms around it. And then last night, word broke for the first time ever. The Treasury broke the $1 trillion in interest. Matter of fact, $1.027 trillion year over year in interest on the debt. And of course, every auction, that number grows, and they broke it down. See, because this is another number they want to lie to you about. See, because the Treasury, the $34 trillion in debt, you have what they call marketable and non-marketable. So marketable, right? This is these auctions, the banks got to buy them, hedge funds buy them, insurance companies buy them, right? Companies buy them, foreign countries, all that stuff. That's over $26 trillion. Right now, the Treasury on their own website says right now, by the way, as of October 31st, the average that they paid was only 3.096%. And here's the problem. That's a really low number because most of the stuff maturing right now is old stuff that had low rates. Only the short-term stuff that has the high stuff is rolling in. This number is going to grow every year for at least the next 5 years. By the way, that payment alone on the $26 trillion was $805 billion worth of interest. Now, that's what they'll like to tell you. Well, we had to pay $800 billion in interest, but there's more. Right? The Social Security Trust Fund and all that stuff. Now, that one, this is what a bad deal that trust fund is. Guess what the rate of return on that one? It's only 2.88%. Right? Because they don't put a lot of short-term stuff in that one. That is another $222 billion in interest. So congratulations. We now are spending $1 trillion plus just on interest on the debt. And the bad news, according to Bank of America, that number only gets worse, Jason, every day that goes by.
Well, yeah, because we're pouring more debt onto the pile, so there's more interest towards that debt. It doesn't matter what the interest rate is. If you pour more debt onto the pile, the money towards the interest paid is going to go higher. You know, I guess if you lower the interest rates, that can help that number tremendously. I guess that's what everybody in the financial markets is waiting for, but it's not going to make a big difference if you keep piling it up the way they're piling it up, Joe. You know, $20 trillion in 10 years might be a very modest conservative number, Joe.
It's going to be one of those situations where, like we have been saying, there's no good answer. And I start thinking about all these central banks pouring money in billions and billions and billions into gold and making a lot of sense. Got to turn that mic on. 800-951-0592. That is our toll-free number. Gold's up $10 here, 1967. Silver's up 27 cents at $23. Got a couple of things. I'll say this right now. If you're a silver buyer, today is going to be a great day to do it. Silver prices over the last 2 days have gone up almost 50 cents. And I've left the price right where it's at. This will obviously can't do that forever. So if you're looking at Silver Eagles, rolls of Silver Eagles, $600. Not bad. Not bad at all. Cases of silver, even better. $14,750. On the gold side, I've got two different options for you. 1/10 ounce American Gold Eagles, $250. By the way, on 10th ounce Gold Eagles, if you buy 50 or more, we're knocking off $5. That's $5 a coin we're knocking off. I'm going to save $250 on a roll. So $250. Buy 50 or more, $245. And then the $5 Liberties, man, I will tell you, last week. Man, we sold so many $5 Liberties, and I was like, man, I wonder if they're going to go disappear. I've got 50 more. I don't have a ton, but I've got 50 more. But it's all about the price, Jason. $565. I don't care how many you buy. So this is normally you got to buy 20, you got to buy 10, you got to buy 50. No, I don't care how many you buy. I got 50 of them. They're $560.
That's all the dollars they could afford. Their wages or their earnings didn't come up quite as quick as gold did, and that's going to happen again. So if you're going to get a $250 10th ounce gold eagle, it very easily can be a $500 10th ounce gold eagle just in a couple of years. You know, so if you want to get out of that funny money and get yourself into some gold and silver to hold your savings in a much more safer place, then this is a good time. I mean, these prices, it may be boring for the guys that listen to us every single day, as gold has not done a lot. It hasn't really blown up in the last couple of years. It's going up just a little bit at a time. But pretty soon that big rise in price is going to come, and you're going to, one of these days we'll say, hey, I remember those $250 10th ounce gold eagles. I say it. How many times, Joe, have you heard me talk when I first came on the air? $1,250 or $1,300 for a $20 Liberty, and it's hardly get those below $2,200 now. It's going to happen again.
And don't be fooled, because it feels like gold hasn't done anything, right? It does.
Yep.
It's up 15, almost 16% year over year. I mean, so really when you look at it, it's done it quietly, right? Because, it's not a straight line. It goes up, it goes down. But here's the trend. And let's go back and let's just take it since 9/11. How about we'll use that date, or maybe Y2K, whatever one. Pick the date, doesn't matter. The trend in gold, very simple. Silver and gold, they're related. I always talk about, gold and silver are brothers, right? Gold's the older, responsible brother. Silver, he's that wild child, always in trouble, likes to party, right? Got wild swings in silver. But they go together. And what we've seen with the breakdown of fiat money. And when did it break down? Well, it broke down in the late 90s. Right, when Alan Greenspan, we're going to pay off the debt. Look at these budget surpluses. They really weren't budget surpluses, but they called them budget surpluses. And, of course, the debt has done nothing but skyrocket since. So we've gone from 4 to 5 trillion. Let's call it 5 trillion to almost 35 trillion, right? We're right there. We'll probably be 35 trillion, right near 35 trillion by the end of the year. Okay, 35 trillion. Now, and we took that. That took us, right, 23 years to add almost $30 trillion. And gold is gone from $300, and really like $250, but $300 to $2,000. Silver has gone from like $4, right, to $23. Now, Bank of America says, hey, in the next 10 years, we're going to add another $30 trillion when you count the Fed's balance sheet. What do you think gold and silver are going to do? It doesn't take a rocket scientist. This is pretty simple. Right? And don't get me wrong. Gold's going to go up. It's going to go down. Right? It's going to do all of those things. Sometimes it's going to go up a lot. Sometimes it's going to go down a lot. But overall, the trend is going to be higher highs and higher lows, higher highs and higher lows, higher highs and higher lows. And if this is any example, think about this, 20-some years, that's a pretty good example size. Right? We should be looking at a gold price, Jason, what? $4,000 or $5,000? That's really. I used to think, oh God, that's outrageous. Let's just get to 2,500 before we talk about 4,000. But that looks extremely likely based on the trend, based on what we've seen. Silver, right? It's the only thing just about that hasn't hit a new all-time high. You got to think silver's got to be, at least back to that $50 range, and a lot of people out there calling for $100 plus silver. This is why.
Well, gold seemed to go from that $1,200, $1,300 range to $1,900 pretty fast. It's been as high as whatever the high was, 2064, but it sure skipped the 14, 15, 1600 range pretty fast, didn't it, Joe?
Well, that's what it does, right? Because it came down from 1900, went pretty far, and then it shot right back up, lickety-split. Patriot Radio News Hour. We'll be back after the break. (800-951-0592). Joe and Jason, Patriot Radio News Hour. The specials today. Gold again up 11 here, 1968. $5 Liberties. So these are going to be, we have two $5 gold coins for sale right now. One's the $5 Liberty. So that's your quarter ounce. That's the older one, 1866 to 1907. You know why I love old gold. You know, and when I start thinking about what Bank of America said, remember, let's not forget, we were only a little over a week ago. Jamie Dimon said, I don't know what these guys are thinking. Wait till 2024 gets here. It's going to get ugly. Remember, now somehow they forgot it. But I'm sitting there and I'm watching this and I'm thinking, you know what? 60, 70 trillion? I mean, we're almost going to double the debt, essentially, in 10 years. Does that mean we're going to pay $2 trillion in interest? Well, it depends. Right? Could be a lot, because you got to remember, we haven't even, it's going to take another 5 years plus, really 10 years from today, if rates stayed right where they were. It won't even be 10 years till most of the debt catches up, because you got to remember, they're only at 3% interest right now. Unless the rates go back down. I mean, Jason, we easily could see $2, $3, $4 trillion in interest, depending on where rates can be. I don't know that it's possible. I guess anything's possible to go back to 0%. Can you go back to 0%? I mean, let's face it, the debt's already, $34 trillion. They won't go from 5 to 0 in a shot. I mean, the debt would have to be at least $40 trillion. That doesn't count the Fed's balance sheet. I don't know that it's even possible to go back to 0. So, yeah, having old gold in your portfolio is a good idea. Because they may just need to take gold to get people to buy the debt, right? Why do you think they have all this talk, the BRICS? Oh, they're gonna issue gold bonds. You're China's gonna issue the gold renminbi bonds, right? Why? Because it gives it what? Credibility. And the world may be looking for credibility after this debt fiasco happens. Let's face it, I don't know that we'll start it. I got a feeling it'll probably start in Japan. But you got the $5 old U.S. Liberties at $5.65. Then you got the 10th ounce American Gold Eagle. Right? That's the real, when we talk about barter gold coins, 10th ounce aren't cool, tanks of gas. Right? You got an RV. An RV takes, big tank of gas, right? Yeah. That may cost you a 10th ounce. It may cost you 2/10. Depending on where that would be. Right? Maybe it's not even gas, right? Maybe by then, Jason, you need to plug in your RV. Right? You need to plug in your RV so you can go somewhere. That may be 5/10. I don't know. They're $250. Then you got silver right now. Rolls of Silver Eagles, $600. Right? You're buying, maybe that's a dozen eggs. Think about, you're like, wow, a dozen eggs. That's, silver's $23. I mean, eggs were what? Over $10 earlier this year? A dozen. We're going to double the debt? Yeah, that may be it, right? They're $600. You want a case of those? $14,750 at 800-951-0592. And remember, when you call up, tell the girls what special you want. You may want some of everything. Let them know. You can pay by check if you want to pick up in our offices in Arizona or Colorado. You can bring cash with you. If you want to use credit card, debit card, we only charge 2%. That's it. 2% if you want to use, and we take them all. Visa, MasterCard, Amex, Discover, 800-951-0592. So it's kind of interesting, isn't it, Jason? They're breathing a sigh of relief in the debt markets, but at the same time telling you how much worse it's going to be over the next 10 years. It's kind of ironic, isn't it?
Absolutely, Joe. And like you said, you were talking about the 20 trillion in 10 years on the last segment. Where do you think the national, that was the Fed's balance sheet, but do you think by January 25 we'll hit 38 trillion on the national debt? I think we'll hit that pretty easily by January 25, right? You're 34, almost a 4 trillion, right?
It'll be real close. Yeah, that's going to be when we look at the next president is inaugurated. We're going to be in that 37, 38 trillion, and that's assuming nothing goes horribly wrong, right? If the economy totally crashes out, then it could be 38, 39. You could add another trillion or two depending. But if things hold the way they are, let's face it. By the end of the first year of the next presidency, we'll be in the 40 trillion.
Yeah, every 2 presidential terms we've been doubling it. Bush Jr. took it from 5 to 10. Obama took it from 10 to essentially 19-ish. So if you take the Trump term and the Biden term, which ends in January, 38 trillion from 19, it's doubling over. We could, in less than 10 years, have 80 trillion, Joe. 80 trillion.
You know what? Because you got to factor in a recession, a slowdown, a bubble bursting somewhere in there. That's how you add another 5 or 10. 800-951-0592. Jason and I will be right back.
With Naturally Inspired.
Final segment here. Joe and Jason wrapping up this Thursday. 800-951-0592. We've got some old gold, some new gold, $5 gold, the Liberties, the older ones, quarter ounce, 565, the 10th ounce at 250. Remember, on the 10th ounce, buy 50 or more, 245. Silver Eagle rolls, 600. You're looking for a neat little Christmas gift, a kind of a higher end gift, a fresh roll of Silver Eagle, $600. Or if you want to buy a monster box of 500, $14,750 at 800-951-0592. And, what most people don't realize is the last time the central banks were on a huge gold buying spree was back in the 60s. And they were figuring out, hey, wait a minute, these guys are really starting to ramp up the entitlements in the United States, which meant, hey, they're going to really start ramping up the government spending. And maybe, maybe we don't want to necessarily be a part of that. And they started turning in their treasury notes for gold. And you kind of think, well, man, that made sense. Of course, what did we have? A period of that hyper-type inflation. And Jason, it's not the same, right? It's not the same. Because think about it, in that 10 years, the debt went from $400 billion to $1 trillion in 10 years. 1981, the first time we hit $1 trillion in debt. Heck, we did that last quarter. But now, not only do we have the same thing again, but Jason, they're buying more now than they ever did during the 60s. And that kind of makes sense, though, doesn't it? Because guess what? That amount of money doesn't buy what it used to.
Especially since COVID and then all that money printing in 2020. I tell many of the customers that are new customers that come in is like, look, if you had $100,000 in your bank account late 19, early 20, you're going to look at that digital sheet and it's going to say, oh, yeah, I still have $100,000 there. And a lot of people feel pretty good. Yeah, I didn't touch it. I'm feeling good. But you could have bought $100,000 worth of stuff back in 1919. Now you can only buy maybe $70,000 worth of stuff. You're losing big time. No matter if banks are closing down or how the markets are going crazy, the inflation has simply taken your savings and you've been spending money with it sitting there. This is why you have to buy gold and silver, to protect your savings. Do not have any long-term savings, and I'm saying anything 12 months or more. If you got it sitting in a bank account, and Joe and I talked briefly a few days ago, we know there's some people with large amounts of money sitting in their bank accounts and they're kind of waiting around. You guys are simply just making a massive mistake. Every day, you're just losing it, Joe. You got to put it in gold and silver. Don't have it sitting there.
Yeah, because the problem that you don't know is, okay, when is that day going to be here? And if you haven't gotten in before that day gets here, all you did is cost you a lot more money to protect that savings, right? You doing it now, I think you're going to be in great shape, especially if you've got a 10-year time horizon. I think you're going to clean up. 800-951-0592. Jason and I, we're going to be back. We got Bill Roberts coming in. It's going to be a great half-inch stuff.
It's a perfect time.